Right, here we go. Um, Monday night Australian time, US market's about to open. Here's the Turkish lira. In one of the jobs I had at the bank, I ran an emerging markets division, or the emerging markets division. And this is the kind of stuff we used to look out for. So what's going on in Turkey at the moment is worth keeping an eye on. This has been a big move in the FX rate. This is so back in September, right? It was around about eight, $8 to the lira. Now it's kind of come up to 14 or 15. That's a big and rapid devaluation, and it's just moved again sharply today. So you can see it's been deteriorating over the long term, right? But this is next level these last couple of months. Now, there's a few studies out there that talk about leading indicators of sovereign defaults. There's a few of them, and Turkey is ticking a lot of boxes. One of them is inflation, above 10%. Inflation in Turkey is about 20%. Another one is a rapid deterioration in the FX rate by 40%, and this is definitely over 40%. Another one is the external debt to GDP ratio being over 50%. The study's a bit old, like the games have changed now, but Turkey ticks that box. Another one is a rundown of foreign exchange reserves. Turkey ticks that box. That's got negative foreign exchange reserves or dollar reserves when you take into account the cross-currency swaps they've used to fund some of their short-term dollar bonds. Another one is the short-term external debt, the ratio of that to their foreign currency reserves being greater than 1. It's definitely greater than 1. They've got 150 billion, I think, in short-term external debt. That's expiring in 12 months. Another one is, and they don't have the reserves to cover that. Another one is sudden resignations of finance ministers, which happened the other week. So pretty much every single box for a sovereign default at the moment is being ticked by Turkey. Now, I think it's got about $400 or $500 billion in debt, so about the same size as Evergrande, right? So it's not that big, right? But it's more interconnected into Europe with banks holding Turkish paper. So this is something to keep an eye out for, because it is one of those little events that would disrupt the markets substantially. So you can see this is just today how it's had another leg up. It had a little pause here, just under 14, and it has ticked up. That is something that is worth keeping an eye on. If that keeps going, I guess for the uneducated, like when the currency tanks and you don't have the reserves to pay off your foreign debt, then you really don't have much choice except to restructure. The credit default swaps are blown out as well, so that makes it that's an indicator of the deteriorating risk situation. So that's the lira. Keep an eye on that one. Back to the rest of the game in town. So where to leave this last week? Yeah, so where I left this last week was we had this kind of like a bit of a double hit down here, and I remember saying that we had this little game of threes, like 1, 2, 3 weak points, but increasing strength on the RSI, and there was 1, 2, and then I guess the third one here, that slightly lower low. So there was these lows which were getting lower but on strengthening RSI, and when I see that particularly on 4 hour, that kind of trio, that's a warning sign. And I was keeping an eye on this line, saying, look, it's a bit of a game whether these things hold or whether that thing's hold. And of course, as soon as it popped, it went off. I'd got out of my short equity futures in the Aussie. There, I mean, it's not a dissimilar story to really what happened over here, right? Where you can see again there's a couple of hits here on the on that RSI. Certainly one there, very strong one there, and that divergence when you're getting lower lows but on stronger momentum, and then it just like took off. So it wasn't unexpected. So I stopped out. So I made my money on this move down in equities. I'm out just sitting back and waiting again to see where it goes. But in the scheme of things, it hit my target, which was that one. So I was pretty happy with that call. Similar here, where I kind of made some money on the way down, gave a little bit on the way back. Just because my natural position is to, given my core portfolio is long equities right up the wazoo, this is how I try and cushion the blow when that tanks. So I do make money on the way down, give a little bit back on the way up, but stay ahead. This, of course, interesting level where we are now. Whether it's going to break it, in all likelihood, looks like it's going to. That's the equity markets. Just on the equity markets, when I look at the Dow looks really sad. This action here, it is just not looking healthy for me. So I've got a bit of a red line in the sand there. I just got a feeling it's going to come back to. It's, I don't know what pattern you call this, but it does not look very encouraging to me. It looks just a bit sketchy, as my kids would say. The NASDAQ, let's have a quick look at the NASDAQ. It I guess, bombed that first target, came back to the second one, did come back to the third. There is a lot of, still a lot of this divergence hanging around, like there and there. And the moves that we had, certainly when you see it, I'm not sure if you see more clearly on the 4 hourly, I guess you do. That was a good, 12% up on that one. We certainly didn't hit that target, and 12% is more down there. That's why I've got that target in there. When I look at what happened here with the strength going up and then the negative divergence here, increasing strength just here, and then that big sharp negative divergence there. That's why I had that target in mind for a bit of a stronger pullback, but these things are very resilient. I don't muck around the NASDAQ, it's too volatile. Not much to report in the Aussie market, except this is just a bit of an example of why the futures is the real market, but again, you can't ignore some of the inherent differences between futures and cash market, particularly in Australia. You can see there's quite a drop here of like 100 points, 382, 294. That was the dividends coming out of the Australian market. So the futures rolled over from Dec to March and probably lost 100 points on the futures just on the roll. So equity is really unchanged, but it lost on the roll because that's when the dividends drop out. The Australian market really is stuck in this sideways action here. You can see a little bit more clear in the cash market just because it takes out some of the noise of the futures from the dividends. It's a bit, this is a dynamic, and you see in the Australian market far more than the US market because the Australian market is very rich on the divvies. So we're kind of like, I guess, on the wide or something like that. On the narrow, I guess it's round about there. That's a key level where we are sitting at the moment. Still struggling to break out and recover those highs. Yes, I mean, this period here, this was some dividends dropping out, back, 6 months ago, right? So we'll see the same thing coming here when the dividends start dropping out. In the currency market, So the currency market, I squared up here. So where I left it here was that it was just trading just above 70 cents. And I remember saying it was heavily oversold on the 4 hour. That's what I like to trade off. I can't remember if it was oversold on the dailies. Yeah, it was oversold on the dailies. Oversold on the dailies. And it was out just outside the Bollinger. I thought, well, look, although I was pretty bearish, kind of thinking it was going to go low, I had a chance. I made the call to square up, which turned out to be a good one. It's promptly rebounded almost 2 cents. I have re-shorted it. 71.70 is where I'm short at the moment, and it started to tick down tonight. I'm watching that pretty carefully with about a 71.90 stop, because you can see here, and the reason for that is a few things. When it bumped up, it did break that trend, right? So there is a chance, a good chance that it could go back up to 75, even higher. Right, so I've got a tight stop because of that. Having said that, I don't really want to go long. Didn't want to go long at this level just because of the cycles, because it was, overbought on the 4 hourly, overbought on the hourly, starting to weaken the momentum. Not a great level to go long at. I'd basically squared up in here. Or squared up, it's like 70.17, so it's just down in here. So I'm just having a go at shorting it, and I suspect it could come down to maybe a cent, down to 70.83, and I think there's a good chance it'll take off again. It will depend on what happens probably with the euro and the dollar index, but you can see that level that it bounced off at, that 70 cents. Big psychological level, like big figure 7, right? The last time it did that, it kind of rallied up to 80, right? So it could well do that, but really, I squared up, which is good. Probably should have gone long, but anyway, coulda, shoulda, woulda. I'm short here, a bit riskier, but we'll see how it goes down. If it hits down to 71 cents, I'll probably buy it back. That's the currency. The bonds, tell you what, the bonds, they've been on the move, particularly in the US. Look at this for the 2 years. Forget all this noise here. They have been really on the move. They are really unfolding higher in terms of the yield there. And you can see pretty clearly when you look at the futures, it is slightly exaggerated because of the roll. Let's look at it daily, just on the lines to make it a picture. This is the big gap that I'd been talking about for ages, saying it's just going to fill it. It is going to fill it, and it's started to fill it. I mean, my broker told me like a couple of months ago. He said, "Mate, look at the 2-year treasuries. It's not sexy, but it's a good trade." He was spot on. So I've been short the 2-year notes. That broke that level, had a bit of a pause around this level, and these little suckers are falling. It's not too late to get on, not a great level, but I'm short. It's got like 109.60, something like that up there. The only problem is you give up a little bit on the roll, but there's still money in it, still a good trade. When we go back to the yield, you can see clearly over the long term where it could well be heading to. This is the way. You can see it just follow this big trend line, just kind of like loops back to it all the time. This is the .com disaster. That was the GFC. Then here, really, I see it coming back. Good chance for it coming back to that trend line. Very good chance for it to come back to this line. That's like 150, right? So there's still like another, what's that? 150. So there's still another 90 points, 80, 90 points in it. Good trade. This is the level where it is now. You can see it'll have could have a little bit of work to do around there. Coming back Now, some of these things that I've got marked in, which I've talked about before, is for the people that still love gold, think it's going to go to all-time new highs. This in 2011, when these yields hit this bang on ding dong low, that's when gold peaked. Right? When these yields started to tick up, that's when gold got dumped and it dropped like literally hundreds of dollars. Right? Around here, this is when gold started its move back up. Right? And of course, here in August 2020, that's when gold peaked. Right? Now, I'm very surprised that gold has hung in there despite this move. Gold is lagging and it is vulnerable. So let's have a look at gold. It is doing this little, lower highs, keeping a constant base. So this is when I talked about it before, like back in August 2011. This was when the yields hit, the two yields hit that low. This is when the yields hit that low again. This is when those yields start to move up. The yields already started to move up. I'm surprised it hasn't moved, right? And of course, when they did move, $500. $500, it'll take it back down there, right? It'll take it back towards $1,200, I think, pretty easily. And you can see this pattern, when it goes up, forms this triangle, comes back down, goes up, forms a triangle, come back down. You can see that pattern in a lot of places. It's actually been in natural gas lately. Let's see if I can find it. Yeah, here we go. What does it show up best on? Yeah, you can see it there, right? You have a run up, right? And it starts forming some lower highs. They start rolling down, and there's this constant base, right? And then when that base breaks, it just breaks. It just falls straight through. So that's in natural gas. You can see, of course, in Bitcoin of all things, and that's the irony, because a lot of the people who love Bitcoin are the same people that believe in gold, going like up to wherever they think it's going to go, right? So when you go back, here we go, I've got it marked here. So you can see Bitcoin has a run up, forms this triangle flag, lower highs, same base, and it just drops down. Yeah, sure, it's recovered, right? But it really does drop off a cliff, and that was a 46% drop. 46% drop, right? Here's another one. You can wipe out this noise, right? Same thing, it had a run up, some lower highs, kept that base intact. I mean, with Bitcoin, I kind of ignore that just because of the volatility, right? And when it fell off, like it kind of came off anywhere between, 53, 60%, let's call it like 50% to be generous. Here's one of the strongest going the other way, right? So you can see, higher lows against the horizontal, and it breaks up. That's kind of what happens, right? That way they break up. These ones, they tend to break down. It tends to break down. So you can see it in different assets, right? So that's in gas, Bitcoin, gold. You look closely, you keep an eye out for it. And that's why I'm very cautious on the gold market at the moment. And interestingly enough, when the inflation print came out last month at 6 point, whatever percent it was, 6.7%, gold really did spike up very sharply. That was that day there. Didn't last very long, came back down. This time when inflation was printed, nothing, right? So to me, this is dumb retail, right? Dumb retail. That's all it was. Because all the people who were buying gold because of inflation, the smart people were doing it back here, right? When rates were starting to come down, and everyone's going, when the rates are coming down and the money presses, the printing presses are running, printing cash, that's when we're going to get inflation. So they buy it. Hits a peak there when the rates were at record lows, and they say, well, look, that's it, time to get out. So they get out. these are the suckers like late to the trade in being long gold, right? And that the sellers just keep kind of pushing them down, and eventually the sellers are going to win, and it will break this. When it breaks, it's going to be ugly. I'm not short gold. In and out of gold is tough just because of it is volatile, right? For me, the easier way to play that macro picture is short the rates, or short the bonds, long rates, short bonds. That's the way you want to look at it. So that's pretty much it for today. So I don't have anything on in the futures in equities at the moment. I'm sitting back and waiting for my signals, the things that I look for, which generally are those. I'll be waiting to see what happens with a 4-hourly RSI. Get overbought or oversold. That's what I'll be waiting for. I think it could be a bit of a range trade. And if it's a range trade, I might have to shorten that horizon to like a 2-hourly. We'll see. So in the equities, I'm not doing anything at the moment. Bonds, I'm still short, 2s, 3s, and 10s. The currency, I'm short, but no, it's not a high conviction one. And I do think that, given that this is broken, right, given that we have become oversold on the dailies, right, and that I think this trend may well have run its course, and it could quite easily go back up to the top of this channel, if not further. So I'm just cheeky short here, and I think I'll be looking to turn around and play it from the long point now. I don't really think we've got enough of a narrative in the markets to drive this thing below 70, and I think there's enough buying. I mean, you can see the buying there. There's going to be a lot of resistance to a lot of support there, I'd say, which is what we saw. It literally ticked under 70 cents here for about the same amount of time that it ticked above 80 here, right? So that's why I'm not long-term short now. It's going to be short, maybe pick up a cent, probably look to turn it, and then go. I'd say this is probably more of a bull flag that is developing, right? This to me doesn't look like a turning point. These things are generally continuations. So you can see here, when it went down, a bit of sideways action. It's a continuation, right? We might see some back here as well, I don't know. To me, it's probably a bit more like that. I think it might have to tighten that up. I don't know if it'll get to 71. I'd say maybe 71.20 if I'm lucky. Maybe 71.30. We might have seen that. Might have seen the buying chance there. But it has had a bit of resistance here, which is what I expected, which is why I shorted it. I've bought previous low. Thought we'd have a bit of struggle there. It's come back down. That is roughly my target. Just the bottom of that range, and that level there that it hit. So I'll see what happens there. So that's the currency, the bonds, commodities, equities, and even a bit of Bitcoin, and of course, good old Turkish lira, going back to my emerging markets days. Look that article up. It's by Nurail Rubini, is one of them. Just look it up. Rules of thumb. There's a whole lot of research out there. Carmen Reinhardt has done a lot of good studies. Worthwhile keeping an eye on, because emerging markets, some of these economies, when they do have traumas, they do have much more than a trickle-on, trickle-down effect. See, it's just coming back a little bit there now. That is quite a move, and it could do one of these like turn and goes. keep an eye on it. It could be one of those triggers. All right, that's about it. Have a good one. Ciao.